Hello everyone, welcome to the Ashworth Wealth Weekly Market Update. My name is Todd McChesney. Kind of jump into this week's slide for you. This week we're talking about U.S. yield curve steepness. Really what it comes down to, we won't spend a ton of time because it can be a little confusing, but I'll try to make this as easy as possible to understand is inverted yield curves are generally not a good thing. What we mean by inverted yield curve is that the short-term bond interest rates are paying more than long-term bond interest rates, which generally is not a good thing. As a general rule, as you tie your money up into a bond, the longer you're willing to tie it up, the higher return you would expect, or higher yield you would expect from that bond. Think of it like a CD. A 3-month CD is generally not going to pay as much as a 12-month CD or a 5-year CD, etc. But in the bond market, generally you get these periods of time where the 2-year and the 10-year treasuries are not following that pattern. Sometimes the shorter term you go, the higher yield you get versus the longer term, and that's abnormal. Usually when those happen, it's a concern for the economy. We've had about 26 months of this inverted yield curve, and as we're looking at it now, it's finally gone back to normal. Part of that is because of the recent decrease in interest rates by the Fed a couple weeks ago, and so you can kind of see from this chart that there are periods of time when the light blue lines are higher than the black lines, and that's a situation where you can kind of see where the short-term bond yields are higher than the long-term bond yields. The gray bars, there's 4 of those across that go vertically across the chart as well, are also showing the recessions. You can see we kind of had a small, quick little recession in 2019. We've had 3 others from 1985. You can kind of see when those are happening. So generally speaking, this is a good thing. But what's interesting is while the yield curve is no longer inverted, the longer you put your money in a bond fund, the higher interest rate you expect to get. That doesn't mean we're out of the water. Some people are still thinking the economy can kind of be on shaky ground. It's hard to know exactly. I wouldn't expect a recession in the near future based on just this. If there's some kind of recession that hits, it's usually based on other factors. But inverted yield curve is sometimes considered a recession indicator, so it's kind of nice to get back to the normal situation. So what does this mean for portfolios is really what we want to get at. Number one, as interest rates have been decreased, those bonds that you hold in your portfolio are now worth more money because they're paying a higher yield than what the new interest rates will be on newly issued bonds. And so while we've been waiting for this to happen, we've been buying in these bonds, and we're riding up that yield curve as interest rates have been going up for the last several years. Now we're at a point where it looks like the Fed is going to start easing, and they're going to lower interest rates. And when they do that, you'll see a big pop on your bonds. And so we always want to make sure we have the right amount of bonds in your portfolio to offset any volatility of the market. But it's always difficult when you have these inverted yield curves. But now things appear to be getting back to normal. So hopefully that'll continue, and we'll be able to see some higher yields on your bond portfolio, hopefully in the 4 to 5 or 6% range as things move forward. So that's kind of what we're hoping for. We'll see how things happen as interest rates continue to either fall or stay the same or whatever the Fed tries to do. So as usual, if you ever have any questions about any of this kind of stuff, let us know. We're hoping to have a good economic outlook for 2025. We're hoping to finish 2024 with a positive outlook as well. We do have an election coming up. There'll be I'm sure some noise. We always talk about how markets perform in the short run based on fear and greed, but in the long run, markets are always based upon profitability. And so bonds are a little bit differently. Are companies able to pay those bonds? What are interest rates looking at? Are they going up? Are they going down? And it's nice to have these little pops when they lower interest rates, where the bond funds can have typically be able to perform a little bit better than they have over the short run. So feel free to give us any calls if you have any questions. Look forward to answering any questions of those as we continue to meet and do reviews. But feel free to ask us anytime we want to meet and go over any of your portfolio, and we'll go from there. And we'll look forward to seeing you next week. Thanks.